has two prominent kind of method. One is traditional method, other is modern method. Okay. Traditional method means non-discounting method. Okay. Non-discounting means we are not using. Okay. So by the time they are joining, let us first take down the question on our Excel sheet. It will be convenient for us to then deal. Okay. Srihari, I hope you must have downloaded the question. I mean this textbook. So just help
Yes,
me
sir.
out with years 0, 1, 2, 3, 4, 5 and cash flow. Okay. So just
Okay, sir.
okay. It will be convenient then for me to. I want these two things. And we are dealing with illustration 1. I fill the outflow. Sorry, there are 5 years. So one extra year we have, so we remove. Really, just tell me what is the cash flow for this illustration. Project A, Project B. Following details are available in respect of cash flow of two projects, A and B. Huh? So just remind me, 4 lakh, then 2 lakh, 1 lakh 75,000, 25,000. Likewise, huh? Okay.
Okay, sir.
So it is 4 lakhs. I want negative 4 lakhs. Then in first year, 2 lakhs. 2 lakh, 1 lakh 75,000, 25,000. That 1 lakh 25,000, 75,000. Sorry, 175 and 25. 2 lakh and 1 lakh 50. 175, 25, 1 lakh 50 and 2 lakh. Again, by that time they will join. Project B is 5 lakh, 1 lakh, 2 lakh, 3 lakh, 4 lakh, and 2 lakh. Now let us have once again a little bit of revision regarding capital budgeting. I told you, when big companies are going to have their diversification or taking any kind of capital investment, I hope you must be knowing the difference between revenue and capital. Anybody who can define me revenue and capital expenditure, revenue expenditure or capital expenditure, which you must have learned in first year degree college.
Sir, revenue expenditure is generally recurring in nature.
Okay,
Recurring expenditure, which is actually in the daily business
superb,
business
superb,
expenditure,
really. Yes,
and capital expenditure is once in a matlab,
after,
in a
yes,
long
yes,
period of
long
time.
period, yes. So for
Like
such
it's basically connected with acquisition of fixed
assets,
assets.
yeah, diversification of business. So for that, we need to have this technique, whether those kind of capital expenditure is required or not. If it is requiring, whether it is viable or fruitful for the business or not. Again, I will take you the case study of UB Group, Vijay Malia. They were very happy with Kingfisher, and still those brand is working. Yes or no? You talk about beer, you talk about what is the other product? They have mineral water also, na? I suppose Kingfisher has their mineral water also. So those things are still in place. But all of a sudden they have taken a capital decision, you know, and capital expenditure decision regarding investing in airline and started with Kingfisher Airline. What has happened with the company? They have lost everything. Agreed or not? Yes or no?
Yes, sir.
Similarly, I have shown you the example of Anil Dhirubhai Ambani, right? Reliance Telecom has finished him, and rather than he has taken again wrong decision of Reliance Power, and today that entire company is nowhere. Whereas the Mukesh Bhai has started with Jio, and today he is there in the appropriate. So there are many examples, okay, which you can take for your case study when you talk about capital budgeting. So either it will make you or it will break you for capital expenditure. Why so much important? Because the decision once you have taken, it cannot be reverted back, right? This required huge amount of investment. This decision are irreversible, reversible. So whatever the decision you are taking for capital expenditure, you take lot many precautions before executing, and thereby this capital budgeting tools are very very vital, important. Okay, thereby they have making market appraisal, whether market is suitable or sustainable for them or not, technical appraisal, economical appraisal. These are the other viable tools which assist the capital budgeting, other than the accounting tool which we are going to learn today, financial appraisal. So, in financial appraisal, we have different capital budgeting tools. One is payback period, other is accounting rate of return, third is net present value, fourth is profitability index, and fifth is internal rate of return. Okay, these are non-discounting criteria. That is why it is known as traditional rule of capital budgeting. These are known as traditional rule, or I can write down non-discounting method. Okay, traditional or non-discounting. Whereas modern method are discounting one. Discounting means they are considering time value of money into consideration. Discounting means they are, and I told you how it goes about it. Again, we have the revision. Again, we will have the practice based on net present value, profitability index, and so on and so forth, IRR. So, traditional method, they will not take the time value of money into consideration. They will not going to multiply by present value, future, interest factor, etc. But in modern method, yes, they are going to do in those uh, techniques, and then only they take the capital decision uh, into consideration, whether they will go about it, they will not go about it, etc. Getting everyone? So today, let us start as it is there, ARR and PBP, one by one. So what is PBP? Payback period. By how many years I am getting my returns back into my account? Say for example, in project A, now these are two projects, whether I should invest in project A or I should invest in project B. I should invest in project A or I should invest in project B. I need to take the decision. In project A, my initial investment is 4 lakh. My returns is like this. In project B, my investment is this 5 lakh and my returns is this. So now I have to take the decision whether project A is better for me or project B is better for me. Till here things are clear to everyone who are attending the lecture? Tell me yes or no.
Yes.
Yeah, I'm not seeing the your message. So it will be better if you can uh, unmute yourself and give me oral kind of representation. Yes, sir, I have understood or not understood. So everyone, tell me whether you have understood or not. Anjali, Nikita,
Yes, sir.
Shruti, Kushbu, Dawn is also there. Okay, and kindly take down. Last time also I have seen that you are not writing in the notebook. Again and again I am telling you, if you will not write in notebook, I am not going to give you the internal CE2 marks. I am making it very clear. There are two kind of CE2 class continuous evaluation of 40 marks. One will be 20 marks ka exam, and I hope you must have got the Mumbai University detail also that exams of PG they wanted to start. That circular is also there on university website. So now you please prepare in perception that your exam is coming very soon. And I told you also in Fab there will be internal, and from 1st March there will be external exam. So we need to focus now because almost 15 January is over. So you have only 1.5 months in your hand to study entire thing and produce it into exam and get a very good marks. Is the things is clear to you all? Yes or no?
Yes, sir.
Okay. So now tell me, I will go one by one method, okay, as it is specified in the book. So let me apply the payback period method, which is explained here. Time duration by which we are getting our money back. Let me see whether it is happening or not. So if I will take this as a frequency and I will calculate the cumulative frequency of project A from here, CF of A, what you are going to get? First, CF, I hope you must be knowing. 2 lakh, yes. Second year, 3 lakh 75,000, yes. Third year, 4 lakh, yes. So I have invested 4 lakh. I'm going to recover my 4 lakh after 3 years. So what is PBP for me? What is the payback period for me? This is my PB
4 year.
third year is equal to third year.
Third.
Understood everyone?
Yes, sir.
For project A. Now if I will apply the same logic for project B, just see what is going to happen. Again, CF cumulative frequency of B, what will happen? First year 1 lakh, second year 3 lakhs, third year 6 lakhs. Agreed or not?
Yes, sir.
So my recovery is there between second and third. Why? Because my investment was 5 lakhs, but I am able to recover 6 lakhs. Yes or no?
Yes, sir.
That
Yes,
means it is
sir.
lying between second and third year. Yes or no? 5
Yes,
lakh
sir.
is between second year and third year. So in such cases, we need to apply this formula. Year prior to full recovery. Year prior to full recovery is what? Second year.
Second year.
Plus balance to be recovered. Balance to be recovered was how much? So 3 lakh we have
2 lakh.
recovered. No, no, no. 3
Yeah.
lakh we have already
3 lakhs.
recovered. Okay. Yes, absolutely right. 2 lakh. Out of 5 lakh, 3 were already recovered till last year. So remaining is 2 lakh. Absolutely right answer. So balance recovery was 2 lakh.
2 lakh.
Okay. And divided by cash flow of year of recovery. So what is the cash flow? Not cumulative cash flow. Cash flow of year of recovery. Cash flow of year of recovery. What is the cash flow of year of recovery, beta? 3 lakhs. This is cash flow now. Are tell me yes or no? Very simple question.
3 lakhs.
3 lakhs. Absolutely right. So 3 lakhs. Now can I have your answer please? Can I have your answer? Two lakh divided by 3 lakh. How much you are getting? Let me start my calculator. You are very poor.
Sir, 2.67.
0.666. Yes. So 2 plus 0.666. I can very much write 2.67
It's
years.
2.67.
Yes. 2.67.
2.67.